Hello, I'm Will. I'm a licensed agent with Hearthstone Home Group, All City Real Estate, and I'm here with a couple of our fabulous lender partners, Jake and Ryan, with Fairway Mortgage, the Wood Group. And we're here to talk about some of the myths and misconceptions that there are with first-time home buyers. I mean, we've all been scrolling TikTok or Instagram and seeing somebody on there lamenting about how homes are unaffordable and you'll never afford anything and you'll be renting for the rest of your life. And, that's just, in our industry, I mean, we hear that stuff all the time. And what we've really learned is that a lot of it is just myth. And so we're hoping to put out some information today and make information available to you so that you can get information, you know where to go for you, and you can figure out what your situation would take if being a homeowner is something that's a goal of yours. And so with that, I'm going to kick it off to Jake and Ryan, and we're going to have a little conversation about what it's going to take to be a first-time home buyer.
Sounds fun.
Yeah.
Yeah. So, I think that what he's talking about, the myth of a lot of people not being able to afford a house, it kind of just comes down to, in my opinion and what I see and kind of what I hear, is it is affordable. That's the biggest thing is everybody has a budget, right? And if we stick to our budget, I'm a big Dave Ramsey fan, so you'll hear me say budget a lot. Houses are affordable. If you're paying rent and you're living somewhere, you're paying somebody else's mortgage.
You're already paying a mortgage. It's just not yours.
Apartment or a house that you're renting. So you're already paying that. It's just a matter of kind of what I see, honestly, is people trying to afford something outside of their budget that they want, versus what they maybe need, or kind of like a starter home, right? This is first-time home buyer. I remember my first house was maybe 1,100 square feet.
Yeah. There's a big difference. Like, first-time home buyers don't need to go out and buy their forever home,
Right. That's key.
It's a little bit of a perception difference there too. So what is affordable might not be your forever home. Mm-hmm. And so, my first house was right at 1,000 square feet. Cost me about $96,000 and lived in it for a few years, and then was able to offload that and upgrade. So when we're looking at being a first-time home buyer, what Jake was saying, we want to look at what your budget can withhold, and then what's your goals in the future. This purchasing your first house is just a stepping stone to creating a more financial stable wealth platform to get you that forever home in the future.
Yeah, and I like what he said there is it's a stepping stone. Your first car, like look back at your first car compared to probably what you're driving now. You've probably worked your way up to maybe a little bit better of a car. So just finding that, putting that in your budget, and then finding that house that you do like, that is in your budget, that fits right now. You're going to build wealth by doing that because you're paying your own mortgage, right? We're building equity in your property. So that's money back in your property, essentially, whether we do a refinance later, whether you sell the house and then you get that money back, or my personal favorite and Ryan's personal favorite is rent, right? Yeah. So you turn your house into a rental house, and now you're having somebody else pay your mortgage, just like you're doing right now by renting. So.
Yeah, I didn't get a check when I moved out of my last apartment. They weren't like, hey, you've been paying us rent for 4 years, here's a check. But when I sold my first house after 4 years, I put a decent chunk of money in the bank and used that to buy the second house that I had. So would have never done that if I hadn't bought my first house.
And I would say just being in this industry for I've been in the rental industry for over 12 years, in the mortgage industry for 6, and Ryan has a lot of experience in both as well. You're probably looking at your starter home, 2-3 year range. I think I was in my house 2.5, 3 years. Yeah. And then, family grew, and so we upgraded. But if I was throwing that money away at rent, probably would have been when I went to go purchase my house, not an upgrade. I would probably have to start at my starter house.
Right.
So starting this process sooner while you are younger definitely is going to have an advantage over waiting and just keep paying out rent, because rent's going to go up.
Yeah.
Yeah. Everybody's younger today than they will be next week. So like younger doesn't mean young.
Exactly.
Right? Like it's never too late to start.
You got to start somewhere.
You got to start somewhere.
Whether you're a first-time home buyer at 60 years old or 26, you're starting somewhere, and it really isn't that hard to start. So qualifying for a mortgage isn't as hard as it used to be. There's a lot of different first-time home buyer programs, down payment assistance programs. Credit requirements are a little bit more relaxed than they have been over the last few decades and such. So yeah, if you're ready to purchase a house, you just got to start.
Yeah. Generally speaking, if I was a first-time home buyer, what are some of the things that I'm looking at for my own personal situation that might key me in, that not necessarily that it's a slam dunk and that I'm ready to go today, but like that I'm working on that path? Like, at what point should I be going, hey, like home ownership is within reach?
Yeah.
So your biggest factors in the basically what you're kind of looking at is, do I qualify for a home, essentially. That would be, your first steps into kind of like, am I ready? So as far as qualifying, generally speaking, first time home buyers, we're going to be using an FHA loan, so that's a government backed loan. The reason that we generally are going to be using an FHA loan is because they require less down payment. So you only need 3.5% down if you're not going to be using a down payment assistance program. We can talk about pros and cons to those here in a little bit, but there's always a pro and a con to each program, right? So, but let's just do a normal FHA loan. Typically, so we need income, right? So we need to make sure that you have a job. One of the myths is I have to have 2 years of employment. That's not accurate. We can actually use, let's say you just got out of college. So we're going to count that 4 years of you in college as employment, essentially.
Okay.
So if you get a job offer letter right out of college, we can use that as past employment. So we're looking for income. And then the next thing is going to be your credit score. Typically, with FHA loans, we like to see 620 credit scores. Depending on the situation, yes, you can go down into the 580 range. But at that point, we'd probably want to try and get you into the 620s just for better interest rates and qualifying purposes. But you can go into the 580 range. So if you have a 580 score or higher, then you qualify there. So we have income, credit score, and then the next biggest one is going to be your debt to income. So when we're looking at debt to income on an FHA loan, typically we want to be around the 45% range. And what that means is that we're going to take your total debts. So if you have college loans, credit cards, car payments, and then the new house loan on top of that, we're going to calculate that up. And we want that number to be all added up roughly about 45% of your total income or your total debts. That number can get kind of skewed because it can go a little higher, a little lower, depending on credit score and things like that. But that would kind of get you pointed in the right path. And then from there, assets, right? So when I say assets, it's going to be, we're looking, if you're just using the standard FHA loan, do you have the money for the down payment? So 3.5% for the down payment. That money can come from a gift. So if you have a family member or a relative that wants to provide that gift to you for that first purchase, they're more than welcome to do that. And then that would be, our assets. So that's kind of your basic qualifications. And then from there, it would just be, what are you looking for? We would kind of sit down and talk to you and kind of see what your goals are and see what house payment fits that goal.
So yeah, it's important that you said what are your goals and what you're comfortable with, is because first-time home buyers, or really any home buyer, they will qualify for more than they want to spend most of the time. So if you come over here and you say, hey, I want a $1,500 mortgage payment, I'm paying $1,400 a month rent, and I can go a little bit higher. Great, we're going to take $1,500 a month and we're going to work backwards and say, okay, this is going to get you this sales price in this city or whatever. You need to refine your search here. But did you know you're actually qualified for probably $3,000 payment or whatever? But that's one of the things about the debt ratio we're looking at, but we're going to probably work backwards off what your comfort level is, more so than just say, hey, you're qualified for this amount, go shop in this amount. So if you're only looking for a $1,500 or a $2,500 payment, we can figure out where you need to be looking at sales price rate. Also, if you say, hey, I've only got $3,000 saved, then we want to make sure that the programs we're putting together for you keep that in mind. So Jake alluded to it a little bit, but down payment assistance, these are great programs if you need them. So there are many different programs, some state funded, some private funded, some in-house, in-state, whatever. But there's a lot of different programs for down payment assistance, and it's a general term, but essentially all it is different ways for you to get assistance money to use for your closing costs or your down payment. And so you can get true grants, you can get second liens that don't have payment on a monthly. You can get deferred second liens where essentially you pay it back when you sell your house, but the money's given to you up front. All these are great options if you've got good credit scores, you've got a good debt ratio, you've got the ability to make the monthly payment, but maybe you had some medical stuff come up and you drained your savings, and you don't have savings.
Right.
We can use this to speed up the process for you to purchase a house sooner rather than extending that lease another 6 months or a year. So down payment assistance, it's a great option. Like Jake was saying, pros and cons. Sometimes down payment assistance does have slightly higher interest rates. There's no such thing as free money. And so the rates might be a little bit higher, but you're getting that money to use for your purchase. So if the payments are still in line with what you're wanting on the mortgage, down payment assistance is a good option. Some of those programs do have reduced interest rates, though, on the flip side of that for first-time home buyers who are below a certain income threshold. So there's some programs that you may get a reduced interest rate rather than a dollar amount credit for your closing costs. And so the benefit of a first-time home buyer could be just reduced interest rates to help make purchasing a house a little bit more affordable. So there's a lot of different programs out there that we can look through, and it really just depends on what your needs are as a buyer. So if you're a buyer who wants the lowest possible payment, great. We got some options for that to help you get there. If you're a buyer who is more flexible on payment but really needs all of the dollar assistance possible, we can look at down payment assistance, or we can even look at negotiating seller credits.
Well, that's what I was about to say. Like the one thing you guys haven't talked about is kind of where I, as a real estate agent, kind of come in, which is you can always ask the seller to pay some of those things. So when you purchase somebody's home, they're motivated to sell it. You want to buy it.
Yeah.
There's always a possibility to get some of that from them and have it credited to the buyer at the closing table. So.
If you present a strong offer to a seller and then ask them to pay your closing costs, and then you also go with down payment assistance, it's very likely you can purchase a house for less than $2,000 out of pocket. Basically just make your earnest money deposit, pay a home inspection if you want to, and it's very
Always pay a home
possible.
inspection. Always pay a home inspection.
And then you're looking at maybe $2,000 or less out of pocket if you can kind of work the numbers. So,
I've actually had first-time home buyers. It was a VA loan, but when everything was said and done, they walked away with a check for a couple $100.
Yeah,
and that's because
very
there's
common,
he put earnest money down, he put option money down, but at the end of the day, when all the numbers got, all the I's were dotted and T's were crossed, they walked away with a little bit of money. So,
one of the things on kind of the down payment assistance, I have a lot of people ask me that just qualify for a normal, let's say FHA or a conventional loan. They hear of these programs and they're like, well, I want free money too.
Yeah.
Well, one of the negatives to it is the interest rates are a fixed interest rate. So whatever program that you qualify for and we use, they're ran through the state chooses those interest rates. We have no control over that, so whether you use us as a lender or another lender that offers that same down payment program, it's the same rate, everything's the same. So one of the negatives would be is if you had enough in seller concessions from the sales side and they were just left over, you can't use that money to buy that interest rate down. Those are fixed interest rates ran by the state.
Okay.
So that would be a negative. Sometimes it's not a pro to use that because we might be able to buy that rate down lower with some of those seller credits. So that would be maybe one of those situations where it's like, hey, it might not be in your benefit to use a DPA program. Just come up with the money for the down payment assistance program. use your own money for the down payment and then buy your interest rate down, or get a lower interest rate that you might qualify for outside of the down payment assistance program. So that would be one of those areas where it's like might not fit your scenario.
One thing too with, I was saying the terminology of like just down payment assistance for general, and really what I think that gets tossed out there, like how can I get 100% financing, right?
Right.
That's what someone's trying to accomplish. Like how can I purchase this house with very little money out of my pocket? So we've been talking about FHA loans primarily. Those require 3.5% down, but you can also do a USDA loan that has 100% financing, or a VA loan if you're a veteran with entitlement, and those are also 100% financing. So those two programs, you wouldn't even need a down payment because it's 100% financing. So those could be good options to look at. They're a little bit harder to qualify for. Obviously, with a VA loan, you need to be a veteran or a spouse of a veteran, like a surviving spouse. Or on a USDA loan, those have a little bit higher or lower income limits, and you also have to be in a particular USDA eligible area. So great options to review. Different requirements, though, to qualify for those programs, but it's a good option to get you that 100% financing. But yeah, that's a lot.
Yeah, no, a whole lot. First-time home buyer, what should be their first step? Should they be going to Redfin and finding their dream home first, or
the biggest mistake you can make?
You need to talk to a lender, talk to us about getting qualified and setting a budget, because you don't want to go look at houses that are, say, $275,000, $300,000, thinking that you qualify, and then realize it's either outside of your qualification range or just outside of what you want to spend monthly comfortably.
But Ryan, I put those numbers in a calculator that I found online, and it said that I could afford it.
Yeah, so that's the problem with Zillow or Realtor.com or Redfin, is that some of those numbers, they're using national averages. It's not local, so they're using national home insurance cost or national property taxes, or most of the time those are going to be based on a 20% down payment, conventional loan. So the payment that they estimate it's not specific to your scenario as a buyer. It is a very generalized estimate, and think about it, they want you to hit the button to call the next person so that someone can get a lead, someone can get a commission, or whatever it might be. And so those numbers are always going to be a little understated, in my opinion, because they want you to continue forward with it. And so education is, we must educate buyers. That's what we are really diligent on, is giving you those options, educating you that this is not the same scenario as this, because you're not putting 20% down. You might not have a 780 credit score. You might not be a fifth-time home purchaser, And so numbers you see online, take it with a grain of salt. Always call someone local. And then, so start the process with a local lender. Don't just hit a button, get pre-qualified, because you're going to get a lot of national generalizations and not local to our market.
I'm gonna piggyback off of what he kind of said, and you might not have caught. Use a trusted local lender.
When you go to a national chain
Online, there you go. It's the same thing. They're not actually doing an actual breakdown of your income. You're just filling in general kind of questions, and they're like, you qualify for X amount. I cannot tell you, and Ryan will say this, and Will say this, being a realtor, how many times people, customers that we've had try to come back and be like, hey, I'm under contract for this house and I close in 10 days, and now all of a sudden I'm not qualified because it went from their pre-qual through underwriting. Now we have to meet guidelines, right? And all of a sudden their DTI is too high because they didn't run their credit, or they didn't collect the right information on their true income. There's a difference between how much money you're really bringing in a month and how much money you're really qualifying for the income. So that can be 1099 employment versus W-2 employment, or like rental income, different things like that. Have to meet certain guidelines of qualifying. So you might think you're making $10,000 a month, but really qualifying, you might be making $5,000 or $3,000 or so. So you really need to get in front of an actual lender who's going to go through your whole file before sending that pre-qual, so you know exactly what you're qualified for and what that monthly payment would be.
Yeah.
So yeah, trusted local lender, not just something online you're sending information to.
And it's the same for realtors. Like, you want someone local that knows the market. They know how to negotiate terms, what the comps are for the house you're looking at, what's a fair value to offer, things like that. Someone who's, if you just find a random person that's not local, they might not be the local expert. Right. So, but yeah, with any part of the real estate process, a realtor, title company, home insurance, home warranty, lender, surveyors, home inspectors, everyone needs to be local because they're the experts in the local market. Sure, you can go find a cheaper or maybe a quicker someone somewhere, but they might not give you the most accurate information to or relevant information to your specific scenario.
So you guys have mentioned credit a couple of times, and look, I'll be the first one to raise my hand. I was not good with my credit when I was younger. As a matter of fact, I think I skipped through my 20s with probably somewhere sub 500. I had to have my Abercrombie credit card, and so anyway, like we're not going to talk. That's not what we're here to talk about. But I know a lot of times when you are going, like even when I was a little bit older and I was going to buy my first home, there was still a couple of things that were like, credit card limits or credit cards were, closer to limits and stuff like that. So can you guys just talk a little bit about, we've mentioned debt to income ratio, we've talked about income, we've talked about some of those ratios, but when somebody's going into this process, what are some of the do's and don'ts around what they should they Google credit repair, credit repair so I can buy a house, or what's the best way to go about that?
All right, so I'll take this one. Just tee it up for me. So credit is a very tricky topic. Let's just cut through right there. Credit is very tricky. There's not a one answer for everyone.
I mean, I not to interrupt, but like I know sometimes when you pull your own credit, it'll be like, oh, you've got a 635 credit score, and then you go to apply for something, and they're like, oh, you're a 610.
Exactly. So is looking at your prior credit history differently to determine if they're going to give you a loan or extend credit to you based on that industry specific. So, for example, someone who is doing auto loans. Do you have enough income to cover this payment one way or the other? Sure, that's almost all they care about. Credit card companies, they want to know, do you have the ability to charge up debt, pay it down, charge up debt, pay it down, without maxing out, without going into default. Mortgage companies, we're looking at long-term debt. We're talking about a 30-year mortgage, so we're going to analyze your credit on a long-term analysis. And so those algorithms are going to be coded a little bit different than what a credit card company might be, or a short-term personal loan company or auto. And so if you pull on Credit Karma and it says 615, there's a good chance that what we see is anywhere from 20 to 30 points different every time.
And not always lower, like sometimes they come back higher.
Yeah, it can be higher as well. So it could be a 630 on Credit Karma and a 660 with a mortgage company. And so credit is really weird, but some of those things like the Abercrombie loans or whatever, that's going to stick with you for 7 to 10 years typically on a credit report. And so the choices you made 5-10 years ago still can influence your credit score, but not always, or maybe not as much depending on what other current debts you have. So real high level for your credit's really like 3 main segments. About a third of your credit is generated based on usage. So like revolving credit card debt, do you have the ability to stay in budget on your credit card? So if you have a $10,000 credit card limit, do you keep it at $1,000 balance or $10,000 maxed out balance? And so you want to keep it at about 30% or lower. And so about a third of your credit score is from credit card debt. Another third is your payment history. Do you have the ability, or do you have a history of making on-time payments regularly? And so if you've missed a payment here or there, not always a deal breaker, but if you miss payments every other month on 3 or 4 different accounts, that's going to bring your scores down quite a bit. And then the third one is just like the length of history. So you might have heard someone say, hey, never close a credit card. If you have a credit card open, just pay it off and leave it there. Because if you close a credit card, that could actually lower your credit scores. If you close a line of credit, it could lower your scores, because you want to have a long history of credit that can generate those scores. So length of history, payment history, and type of history, like usage, utilization. Those are the three big factors on credit score. Collections, charge-offs, those aren't great, but they don't necessarily mean automatic denial for a mortgage.
Sure.
Especially if it's a medical collection, we can typically ignore those. They will hurt your credit scores potentially if it's a medical debt or something like that, but it doesn't.
But that's all very situational.
Very situational.
Like, this person that has a medical debt that got discharged may not qualify, where this person may qualify.
Correct.
And so again, that's kind of where the local,
Yep.
working with your real estate agent, working with your local lender to find out what's best for you.
Right.
Now, are there situations where maybe, like, because of your credit score, you may qualify for this particular program, but you're not going to qualify for this particular program? So it's not that you can't get qualified, it's just that because of your situation, you may get qualified for something different than, you could have a twin that has the exact same job, the same income, and one of you will qualify for this, the other one will qualify for this, because there's still differences in that scenario a little bit.
And you're kind of hitting on a part that I like is, first off, if you have what you would call bad credit, right, or what you're thinking of, maybe I'm nervous, like I'm just not going to qualify. First off is everything's repairable, right? One of Ryan and I's passions, and we do a lot of this, is we do a lot of credit repair for free. Mm-hmm. So the whole Google credit repair, they're not a mortgage lender. They don't know what you're trying to qualify for. They don't know the market. They do not understand. Let Ryan and I help you repair your credit and build your scores up. We're good at it, and sometimes you might not be that far off. I have had customers, no exaggeration, 1 second they're qualified, we run them through our credit repair program, and the next second after they do what we said, they're qualified. Like, it can be that fast. Sometimes it takes weeks, sometimes it takes a month, sometimes it can take a year or more, right? It just kind of depends on, the repair that we need to do. But don't be scared, don't be embarrassed, reach out to us, that's what we're here for. Life happens, we understand medical debts and divorces and all that kind of stuff that can really take a damper on your credit. We've been there, we've lived that, and that's what we're here for, is to help you through that. So first off, don't be embarrassed, take that step to repair it. If owning a house is something that you want to do and you don't think you're ready, we'll get you there.
Well, we got to start somewhere, and if you know you have a little bit of credit work to do, apply today, because that gives us more time to help you bring your scores up. And sometimes time is your best friend.
Correct.
If you come and apply and your lease ends in April, and now we have 2 months to get you approved and into a house before you have to go month to month or extend your lease, that doesn't give us much time to help boost your credit score. But if you just signed a 8-month or extension or whatever, now we have a year to work with, whatever the timeline is, there's a lot more that we can advise you on with a year to raise your credit scores than only 2 months. And one thing.
Guess how much that costs? It's free. It doesn't cost any money. So when you go online and you're trying to pay, I cannot tell you the amount of money that I've seen customers paying for credit repair. That hundreds and thousands of dollars a month for this credit repair that really sometimes doesn't do anything. We're free.
And the reason why we say that too is that let us help you, is because one thing that credit repair companies are just notorious for is they're going to just go in and dispute all of your old debt and try to get it deleted. It's one method. It can work. It could also never work.
Right.
And so when you have all these disputed accounts on your credit, especially if they're derogatory, like collections, past due, whatever, once those accounts become disputed, it doesn't really impact your credit score. So you're getting an artificially high credit score. And we know that as a mortgage lender. So if you have too much debt that's disputed, what you could qualify for, even if you have a 700 credit score, is way lower because you have disputed debt. So these companies that you're paying money to go and help you raise your credit score, when all they do is dispute or just drag it out, that could actually be hurting you from qualifying for a mortgage. So we're going to advise you on how to raise your credit with the sole purpose in mind. The sole goal is to qualify for a mortgage.
As cheap as possible.
Yeah.
So paying off strategically which debts. Sometimes it could be like, pay this one off put $12.24 towards this account, put $10.05 towards this account. It's very strategic. And so it's going to choose the cheapest route possible to help you qualify. And you're not paying a company on top of that while you're trying to pay these debts off. So it's way cheaper and more effective. And then to kind of answer your second question on that was, are there different programs that I can qualify for with a lower score versus a higher score, if you have the twin situation? Absolutely. So for your down payment assistant programs, most of those are going to want a 620 to 640 depending on the program, versus just your standard FHA. You can go down into that 580 range. Then if we bump up into conventional, if for whatever reason you qualified for a conventional and you wanted to go conventional, typically you need 5% down. There are programs conventional where you can do 3% down as a first-time home buyer. Again, pros and cons, right? But yeah, so for a conventional loan, you're going to need at least a 640 credit score or higher. And then again, that's on that lower range, so we'd really want to see a little bit higher. So yeah, one score, or two different scores, same income, can definitely have a different impact on what you would qualify for.
So the bottom line is, reach out to your local lender, reach out to your local real estate agent, and that's always the best place to start, because they know your market, they know what's happening in your market. They, going back to the USDA loan stuff, that's very address specific.
Correct.
The VAs, you have to be a veteran. FHA, that home has to be in a certain condition. Same thing with VA. They have to be in a fully functioning condition when they're VA or FHA. So, that's why those programs work really well for first-time home buyers, because they're not walking into a property that needs, a ton of work. Not saying that they are not going to want to paint, or they're not going to want to update fixtures or do anything, but they don't have to do anything to be able to live in that home with those programs. So,
I like what you said there. When you start looking at houses that, for a first-time home buyer is, a lot of people are like, oh, this paint's horrible, and they just want to walk out. It's like, you liked everything else in the house, right? Yeah, I love it. I hated the paint, and
paint brushes are cheap.
Yeah, you'll see, you as the realtor see it, they'll walk away. You got to have that vision of, can this be either addressed, or can I live with it for 2 years?
But that's the benefit of buying a house, is because you can change it.
Right.
If you don't like the color of the walls, paint it. If you don't like the cabinet hardware, change it.
Right.
You own the house. If you want to knock down a wall later, you can knock down a wall.
Probably would recommend calling a contractor and make sure it's not load bearing. But at the end of the day, if you still want to do it, it's your house.
So there's a lot of benefits of buying a house. Also, tax benefits. As a first-time home buyer, you can get what's called a mortgage credit certificate, and so essentially it's like a 20% rebate on the interest you pay on your mortgage every year. So if you pay $10,000 a year in interest, you would get a $2,000, 20% of $10,000, $2,000 credit on your tax refund every year. So if you normally get a $3,000 tax refund, now you're going to get a $5,000. Every year you're going to get that extra 20% credit back as on your taxes as a tax rebate, essentially, for interest. So not just can you change the house and whatnot, you're going to get tax benefits. The equity in your house is going to go up. So typically the market appreciates 3 to 5% a year.
3 to 5% a year.
So if you're paying down your mortgage balance 1 or 2% a year, and your property value is going up, so let's say 3% a year. If you got a $200,000 house, every year you're making $6,000 just by owning that house. If you were to go and sell that house in 5 years, and when you bought it for $200,000, now that house is probably $240,000 to $250,000 house.
And that's just if you maintained it.
Yeah.
That's not if you upgraded the bathroom or upgraded the kitchen. You're building equity in that, and that's Then the second house you buy, now you've got a amount of cash that you can put down for that, and buy down your interest rate, or whatever you need to do at that time to get into that next home.
So, and that's the fun part of our job, especially as the financing side for Jake and I, is asking you those questions as a buyer, what's your goals? tomorrow? What's your goals in 3 years? What's your retirement goals? Let's figure out how we can strategize for you so that if you only want to have one house, great, that's perfectly fine. It's your goal. If you want to have 10 houses in the next 40 years, great, let's figure out a plan that every 3 to 4 years you're upgrading or whatever it might be. And those are strategies that we can help you out with and show you what it's going to take now.
All right. Any closing thoughts?
Start now. I mean, like Ryan said, he's got a quote. I'll let him say it. Your lemon tree quote.
You mean the acorn?
Acorn. When is the best time to
that
fruit?
Yeah.
So this goes with, you know, when you're going to buy a house. You know, this is a good quote.
There's an old quote that says, or proverb that says, "When's the best time to plant a tree?" 20 years ago. When's the next best time to plant a tree? Today.
Yeah.
So essentially, if you're looking back at 20 years from now, you can second guess yourself. Oh, I should have done this. I should have done that. But as long as you start, as long as you take that first step, now you've got options. If you never start, that tree will never grow.
Yeah.
Yeah, you're never going to produce fruit off of it. So,
Yeah.
I like that one.
Yeah. Best time to buy real estate is 5 years ago.
Yeah.
You know, like, it's
Yeah,
always,
I mean, all three of us are probably sitting here just shooting ourselves in the foot thinking, oh man,
Yeah.
had I done that?
oh yeah, 100%. Like,
Especially being in the industry and seeing it climb and seeing rates just, you know, go up and down. And that's the other thing. I'm going to go off of this. Don't worry about the interest rate. Like, people are so obsessed with the interest rate. Interest rates go up and down. You can refinance at any time. So if you get locked in at, let's say, you know, 7% rate, and then interest rates drop to a 6, or, you know, whatever we think they're going to drop to, you can refinance your house, and then that lowers your monthly payment, and then you also get the matching rate. So you know, marry the house, date the rate.
Yeah.
That's a huge saying, and there's nothing truer than that. Is like, don't stress about the rate, because if you're not in the house, let's say you're renting a house,
you're paying 100% interest.
you're paying 100% interest,
Yeah.
right? And the person who owns that house most likely has a mortgage that you're covering, so it doesn't matter what the interest rate is. So that's where it's just like, hey, what are you comfortable with monthly?
Right.
And then we set that into your hands. Hey,
Yeah.
they want a $1,500 house, go find them a $200,000 house that they like.
And
then
again,
pass
that,
that
like, interest rate at the end of the day is just one input into the equation of how much you're paying monthly. And so depending on your situation, it may be what you qualify for, it may be what you're comfortable with.
Correct.
Yeah.
But at the end of the day, like, you're looking for a dollar amount. And for first-time home buyers, like, that's probably one of the most important things is, like, at the end of the day, what is the monthly payment?
Yeah. We're going to do everything we can to get the lowest interest rate possible for you. But
Obviously.
kind of like you said, at the end of the day, once you move into a house and start making your mortgage payment, unless you're one of the rare people who audit your statement every single month, you pull it up and say, okay, I'm paying this much towards this much towards this is my interest rate. Most likely, you're going to put your mortgage payment on automatic payments, and you just know that every month on the 5th, $1,700 comes out. Every month on the 5th, you know, and you might actually forget what your interest rate is.
Yeah.
So it's important on the pre-qualified side and in setting that budget. But once you've bought your house, it's the payment that's the same every month, and that's what's important. So, yeah.
And at the end of the day, like, the difference between, and we're talking in today's market as of January 21st, 2025, interest rates around 7%.
Yeah.
Now, if you have a little bit lower credit score and you're paying 7.5%, or if you have a little bit better score and you're paying 6.8%, to keep a $1,500, like, regardless of those three situations, to keep a $1,500 payment, you're only talking about a couple of $1,000s on the back end for the price of the house.
It's completely
So
almost irrelevant.
it's not like you're going from a 4-bedroom, 3-bath mansion to a 1-bedroom, 1-bath shack between a 7.5% and a 6.8% interest rate. So, like, yes, that's a little bit extreme, but at the end of the day, we are talking about relatively small dollar amounts.
Well, in the small, first time home buyer, right, you're typically, let's say, $200,000 range to $275,000. And then, when we're talking quarter of a difference in rate swing one way or the other, depending on, their credit scores and what their qualifying interest rate is, it's a $275,000 loan or whatever, so it's a much smaller number than your mansion, where you're talking $1 million loan, a quarter swing can be a big difference, right? But when we get anything under $300,000 for, it's a very minor difference. So if you qualify, you qualify. The rate is pretty irrelevant.
Right.
Yeah. So my sign-off tidbit, I guess, or fun fact is that since the Great Depression, there's never been a decade where real estate values have dropped. Every decade for the last 13 decades now, real estate values have increased. So if you think about buying a house as an investment and not as just a luxury, it's one of the safest financial choices you can make if you're looking at it as a long-term. Even short-term makes sense, but long-term, real estate holds its values. You go buy a boat, it's going to depreciate. You go buy a car, it's going to depreciate. An RV, depreciate. Even some types of quote-unquote affordable housing, maybe like a detached tiny home on wheels or whatever, most likely that's going to depreciate. But if you're looking at buying real estate, data says for the last 120 plus years that your value is going to go up, and so you're going to capitalize on that appreciation. So it's super safe. It is a great way of building wealth long term, and it just gives you more control of your housing than if you were depending on rent.
People get stuck in the small ups and ups and downs, right? So they're like, oh, I'll wait till it comes down. We're talking thousands of dollars when the long-term trend is just straight up.
Right.
Trying to catch something in one of these, it's not a smart move.
Right.
Playing
the long game. We're not gambling.
We're not investors here. Right. We're not trying to nickel and dime everything. We're playing a 3 or 4 year window here. That's you're going to lose out every single time if you try and catch in a dip.
Right.
So
bottom line is, if you want more information, we'll have QR code link in the descriptions. Reach out. We'll be more than happy to provide more information, and we'll have our contact information linked. So if you need a realtor or looking for somebody on the mortgage side of it, we'd be more than happy to talk to you about your specific situation, because at the end of the day, that's the biggest part, right? All of this is very situationally dependent.
Yeah.
And so the only way you're going to know what you can do as a first-time home buyer is talking to a professional. So let us know how we can help you, and we're looking forward to it. Y'all have a great day.
cool.
All right, now that did something weird about 5 minutes ago. The camera did. So
run out of data or space.
I don't. Cut.
Reset.
It's good to have some outtakes. It's good to have some outtakes
About that live.
about that live video. Yeah.